Question 1. The efficiency study reveals that the marketing department's expenditure on digital advertising campaigns is exceeding the allocated budget for the current quarter. To address this, which of the following actions best aligns with maintaining both fiscal responsibility and effective marketing operations, while ensuring accurate reporting? Option A. Discreetly shift a portion of the excess digital advertising costs to the general administrative expenses category to avoid reporting a marketing budget overrun. Option B. Conduct a detailed analysis of the underperforming digital advertising channels and reallocate funds from those with lower conversion rates to more successful ones, while documenting all changes and their financial impact. Option C. Increase the overall marketing budget for the quarter to accommodate the current spending levels, assuming the campaigns are generating sufficient leads. Option D. Immediately halt all digital advertising campaigns to prevent further overspending and reevaluate the strategy for the next quarter. Correct answer is D. Immediately halt all digital advertising campaigns to prevent further overspending and reevaluate the strategy for the next quarter. Explanation. This scenario presents a common challenge for insurance agency marketers, balancing ambitious marketing goals with finite financial resources. Professional difficulty lies in making strategic decisions about resource allocation and expenditure adjustments without compromising the effectiveness of marketing campaigns or violating regulatory requirements for financial reporting and transparency. Careful judgment is required to ensure that budget adherence does not stifle innovation or lead to missed opportunities, while also maintaining accurate and timely reporting of all marketing expenses. The correct approach involves a proactive and data-driven method of monitoring marketing expenditure against the allocated budget. This includes regularly reviewing campaign performance metrics alongside financial outlays. When deviations occur, the professional marketer should analyze the root causes, whether it's underperformance of a specific channel, unexpected cost increases, or a shift in market dynamics. Based on this analysis, they would then implement targeted adjustments, such as reallocating funds from less effective initiatives to more promising ones, negotiating better rates with vendors, or refining campaign strategies to improve ROI. Crucially, all such adjustments and their financial implications must be meticulously documented and reported to relevant stakeholders, adhering to the agency's internal policies and any applicable regulatory guidelines regarding financial record-keeping and marketing expense disclosures. This ensures accountability, transparency, and compliance. An incorrect approach would be to simply cut spending across the board without a strategic rationale. This might appear to address a budget overrun, but can severely damage marketing effectiveness, potentially leading to a decline in lead generation and sales, and ultimately harming the agency's long-term growth. It fails to address the underlying reasons for the budget variance and demonstrates a lack of strategic thinking. Another incorrect approach is to ignore minor budget overruns, hoping they will self-correct or be absorbed later. This can lead to significant financial discrepancies that are difficult to rectify and may indicate a lack of diligent oversight. It also creates a risk of non-compliance with reporting requirements if expenses are not accurately captured and reported in a timely manner. A third incorrect approach is to shift expenses to other budget categories without proper justification or documentation. This is a deceptive practice that misrepresents marketing expenditure, potentially misleading stakeholders about the true cost of marketing activities and violating principles of financial integrity and transparency. It undermines trust and can lead to serious regulatory scrutiny if discovered. Professionals should employ a decision-making framework that prioritizes continuous monitoring, data analysis, and strategic adjustment. This involves establishing clear performance indicators for marketing activities, setting up regular review cycles for both performance and budget, and fostering a culture of open communication regarding financial status. When faced with budget challenges, the process should be: 1. Analyze the variance and its causes. 2. Develop data-backed solutions for adjustment. 3. Implement changes with clear documentation. 4. Report all adjustments and their impact transparently. Question 2. Operational review demonstrates that a new insurance agency is experiencing slower client acquisition than anticipated. The agency's marketing team has proposed several strategies to address this, including highlighting perceived weaknesses in competitor policies, emphasizing aggressive pricing that may not be sustainable, and focusing solely on the agency's newest product offerings without comparing them to established market alternatives. Which of the following approaches best aligns with regulatory requirements for ethical marketing and competitive analysis? Option A. Emphasize the perceived shortcomings of competitor insurance policies and highlight the agency's aggressive pricing as a primary differentiator, even if long-term sustainability is uncertain. Option B. Focus marketing efforts exclusively on the agency's newest product, making bold claims about its superiority without direct comparison to existing market offerings. Option C. Adopt competitor marketing slogans and pricing structures directly to quickly gain market share, assuming these methods are effective. Option D. Conduct a comprehensive analysis of competitor products, pricing, and marketing to identify genuine points of differentiation and communicate the agency's unique value proposition truthfully and transparently. The correct answer is D. Conduct a comprehensive analysis of competitor products, pricing, and marketing to identify genuine points of differentiation and communicate the agency's unique value proposition truthfully and transparently. Explanation. This scenario presents a professional challenge because an insurance agency must navigate competitive pressures while adhering strictly to regulatory requirements designed to protect consumers and ensure fair market practices. The agency's marketing strategy must be both effective in attracting clients and compliant with all applicable laws and guidelines. Misinterpreting or ignoring competitive intelligence can lead to marketing practices that are misleading, deceptive, or unfair, thereby violating regulatory mandates. Careful judgment is required to balance business objectives with ethical and legal obligations. The correct approach involves a thorough and objective analysis of competitor offerings, pricing, and marketing messages, followed by the development of a marketing strategy that highlights the agency's unique value proposition without making unsubstantiated claims or disparaging competitors. This approach is correct because it aligns with regulatory principles that prohibit false advertising, misleading statements, and unfair competition. Specifically, it upholds the spirit of regulations that require truthfulness and transparency in marketing, ensuring that consumers can make informed decisions based on accurate information. By focusing on its own strengths and differentiating itself ethically, the agency avoids regulatory pitfalls. An incorrect approach that involves exaggerating the benefits of its own products or services while downplaying or misrepresenting competitor offerings is ethically and regulatorily unsound. This constitutes deceptive advertising, violating regulations that mandate truthful and non-misleading marketing. Another incorrect approach, which is to adopt competitor pricing or marketing tactics without understanding their underlying justification or regulatory compliance, risks inadvertently engaging in practices that are prohibited, such as price fixing or predatory pricing, or making claims that cannot be substantiated. A third incorrect approach, which is to focus solely on competitor weaknesses without a balanced view of the market and the agency's own strengths, can lead to a narrow and potentially inaccurate understanding of the competitive landscape, resulting in a marketing strategy that is either ineffective or non-compliant. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the regulatory environment. This should be followed by objective market research, including a balanced assessment of competitors' strengths and weaknesses. The agency's unique selling propositions should then be identified and communicated truthfully and transparently in marketing materials. Any marketing claims must be substantiated and comply with all relevant advertising standards. This systematic approach ensures that competitive analysis informs a marketing strategy that is both effective and compliant. Question 3. Operational review demonstrates that the UK insurance market is experiencing significant shifts due to evolving consumer expectations regarding digital engagement and a heightened awareness of environmental sustainability. An insurance agency is considering updating its marketing strategy to leverage new social media platforms and promote its green insurance products. Which of the following approaches best aligns with the regulatory framework for insurance marketing in the UK and ensures a comprehensive response to these macro-environmental factors? Option A. Focusing exclusively on the social and environmental aspects of the marketing strategy, assuming that positive messaging will inherently satisfy regulatory requirements and consumer demand, without considering other pestle factors or specific legal obligations. Option B. Conducting a thorough PESEL analysis specifically for the UK insurance sector, evaluating how political, economic, social, technological, legal, and environmental factors influence consumer behavior and regulatory requirements, and then adapting marketing strategies to ensure compliance with FCA principles and data privacy laws while capitalizing on emerging opportunities. Option C. Prioritizing the adoption of the latest social media marketing tools and developing promotional content that highlights the environmental benefits of specific insurance products, without a formal assessment of how these changes align with FCA advertising rules and data protection legislation. Option D. Implementing a marketing strategy that solely focuses on economic competitiveness and price promotions to attract new customers, disregarding the impact of social trends and environmental concerns on consumer purchasing decisions and regulatory scrutiny. The correct answer is C. Prioritizing the adoption of the latest social media marketing tools and developing promotional content that highlights the environmental benefits of specific insurance products, without a formal assessment of how these changes align with FCA advertising rules and data protection legislation. Explanation. This scenario presents a professional challenge for an insurance agency marketing certificate holder by requiring them to analyze the impact of macro-environmental factors on their marketing strategies within the specific regulatory framework of the UK. The challenge lies in accurately identifying and prioritizing which PESEL factors are most pertinent and how they necessitate adjustments to marketing approaches to ensure compliance and effectiveness. Careful judgment is required to move beyond superficial observation and engage in a deep analysis of how these external forces interact with insurance marketing regulations. The correct approach involves a comprehensive assessment of how each PESEL factor, as it pertains to the UK insurance market, influences marketing activities. This includes understanding how political decisions, e.g., government policy on consumer protection, economic shifts, e.g., inflation impacting disposable income for insurance premiums, social trends, e.g., changing attitudes towards risk and insurance, technological advancements, e.g., digital marketing channels and data privacy, legal requirements, e.g., FCA regulations on advertising and product disclosure, and environmental concerns, e.g., climate change impacting insurability and demand for certain products, necessitate specific marketing adaptations. For instance, a new FCA directive on clear and fair product information directly impacts how marketing materials must be designed and disseminated, requiring a focus on transparency and consumer understanding. This approach aligns with the regulatory duty of care and the principles of treating customers fairly, ensuring that marketing is not only compliant, but also ethically sound and effective in the current market landscape. An incorrect approach would be to focus solely on economic factors without considering the legal and regulatory implications. For example, simply noting an increase in inflation and proposing aggressive price-based marketing without assessing whether such tactics comply with FCA rules on fair pricing and value for money would be a regulatory failure. Another incorrect approach would be to adopt new technological marketing tools without ensuring compliance with data protection laws like GDPR, which is a legal and ethical imperative. Furthermore, ignoring social trends that might lead to a demand for new types of insurance products, or failing to adapt marketing messages to reflect evolving consumer expectations regarding sustainability, would represent a missed opportunity and potentially a failure to serve customer needs effectively, which can have indirect regulatory consequences. Professionals should employ a structured decision-making framework that begins with a thorough understanding of the current UK regulatory environment for insurance marketing, including guidance from the Financial Conduct Authority, FCA, and relevant industry codes. This should be followed by a systematic PESEL analysis, specifically tailored to the UK context. For each identified factor, the professional must then assess its direct and indirect impact on marketing strategies, critically evaluating potential compliance risks and opportunities. The final step involves developing and implementing marketing plans that are not only strategically sound, but also demonstrably compliant with all applicable laws and regulations, prioritizing consumer protection and fair treatment. Question 4. What factors determine the appropriate balance between persuasive marketing techniques and the need for clear, accurate disclosure of policy terms and conditions when promoting insurance products to potential clients? Option A. The competitive landscape, focusing on strategies that highlight unique selling propositions without necessarily detailing all potential drawbacks or exclusions to gain market share. Option B, the agency's internal sales targets and commission structures, prioritizing the achievement of sales goals through impactful messaging, even if it means a less detailed presentation of policy specifics. Option C, the specific regulatory framework governing insurance marketing, including prohibitions against misleading statements and requirements for material fact disclosure, alongside the ethical obligation to ensure consumers make informed decisions based on a complete understanding of the product's benefits and limitations. Option D, the perceived level of sophistication of the target audience, with a tendency to simplify information for less knowledgeable consumers, potentially omitting some technical details. The correct answer is C, the specific regulatory framework governing insurance marketing, including prohibitions against misleading statements and requirements for material fact disclosure, alongside the ethical obligation to ensure consumers make informed decisions based on a complete understanding of the product's benefits and limitations. Explanation: this scenario presents a professional challenge because an insurance agency must balance aggressive marketing strategies with strict adherence to regulatory requirements designed to protect consumers and ensure fair market practices. The challenge lies in crafting promotional materials that are both appealing and compliant, avoiding misleading statements or omissions that could lead to consumer harm or regulatory sanctions. Careful judgment is required to ensure that all marketing efforts accurately reflect the product's features, benefits, limitations, and associated costs, without creating unrealistic expectations. The correct approach involves developing promotional materials that are clear, accurate, and not misleading, while also considering the target audience's understanding and the specific product being marketed. This aligns with regulatory frameworks that mandate transparency and prohibit deceptive advertising practices. For instance, regulations often require disclosure of key policy terms, exclusions, and the financial implications of the product. Ethical marketing also dictates that the promotion should not exploit vulnerable consumers or create a false sense of security. An incorrect approach that focuses solely on aggressive sales tactics without adequate disclosure or accuracy would fail to meet regulatory standards. This could involve exaggerating benefits, downplaying risks, or using persuasive language that obscures important details about the insurance product. Such practices are often considered deceptive and can lead to significant penalties, including fines, license suspension, and reputational damage. Another incorrect approach might involve tailoring promotions to specific demographics in a way that could be construed as discriminatory or exploitative, even if not explicitly prohibited by law. Regulations often aim to ensure fair access to insurance products and prevent unfair targeting. A third incorrect approach could be to use overly complex jargon or technical terms in promotional materials that are not easily understood by the average consumer, thereby hindering informed decision-making. While not always a direct violation, it can be seen as a failure to promote with clarity and fairness. Professionals should employ a decision-making framework that prioritizes consumer protection and regulatory compliance. This involves a thorough understanding of the product, the target market, and all applicable laws and guidelines. Before launching any marketing campaign, a review process should be implemented to ensure that all promotional materials are accurate, transparent, and ethically sound, and that they do not create misleading impressions about the insurance product. Question 5. Examination of the data shows that the insurance agency is considering expanding its client base. The agency has identified several potential market segments based on preliminary demographic and economic indicators. The marketing team is proposing to focus on segments that appear to have the highest disposable income and the lowest perceived risk, believing this will maximize profitability and minimize administrative burden. What is the most appropriate approach for selecting a target market in this scenario, considering regulatory compliance and ethical marketing practices? Option A. Target segments that are currently underserved by competitors, believing that a lack of competition indicates an easy entry point and that regulatory oversight will be less stringent in less crowded markets. Option B. Prioritize segments with high disposable income and low perceived risk, as these are likely to be the most profitable and easiest to serve, and then ensure marketing materials are compliant with general advertising standards. Option C. Focus on segments with the largest population size and the highest growth potential, assuming that market share will naturally lead to profitability and that regulatory concerns will be minimal in large, growing markets. Option D. Conduct a comprehensive analysis of potential target markets, evaluating their specific insurance needs, the agency's capacity to serve them ethically and effectively, and ensuring compliance with all relevant regulations, including those related to fair treatment and non-discrimination. The correct answer is B. Prioritize segments with high disposable income and low perceived risk, as these are likely to be the most profitable and easiest to serve, and then ensure marketing materials are compliant with general advertising standards. Explanation: this scenario is professionally challenging because it requires an insurance agency to balance the pursuit of business growth with its ethical and regulatory obligations to serve the public interest. Selecting a target market involves making strategic decisions that can have significant implications for consumer access to insurance products and the agency's reputation. The agency must ensure its marketing efforts are fair, non-discriminatory, and comply with all relevant regulations designed to protect consumers and promote a healthy insurance market. Careful judgment is required to avoid practices that could lead to adverse selection, market exclusion, or reputational damage. The correct approach involves a comprehensive evaluation of potential target markets, considering not only their profitability, but also their needs, accessibility, and the agency's capacity to serve them ethically and effectively. This includes assessing the regulatory environment, potential for adverse selection, and the agency's ability to provide appropriate products and services. The agency must ensure that its target market selection does not result in unfair discrimination or the exclusion of vulnerable consumer groups from necessary insurance coverage. This aligns with the overarching regulatory principle of ensuring fair treatment of all customers and maintaining market integrity. An incorrect approach would be to solely focus on demographic characteristics that are easily identifiable and appear to offer high profitability, without considering the broader implications. For example, targeting only affluent individuals based on income alone, without assessing their specific insurance needs or the potential for discriminatory practices, could lead to regulatory scrutiny. This approach fails to consider the ethical imperative to serve a diverse range of consumers and could inadvertently exclude individuals who genuinely require insurance products. Another incorrect approach is to target a market segment based on assumptions about their risk profile without robust data or a clear understanding of their actual insurance needs. This can lead to mispricing, inadequate coverage, or the marketing of unsuitable products, all of which are regulatory and ethical failures. It also risks creating a perception of predatory marketing. A third incorrect approach is to ignore the regulatory landscape and focus purely on market saturation or competitive advantage. This oversight can lead to non-compliance with advertising standards, disclosure requirements, or suitability rules, resulting in fines, reputational damage, and loss of license. Professionals should employ a decision-making framework that begins with a thorough understanding of the agency's strategic objectives, followed by a detailed analysis of potential market segments. This analysis must incorporate market research, an assessment of consumer needs, an evaluation of the competitive landscape, and a comprehensive review of all applicable regulatory requirements. The agency should then select target segments where it can provide value, operate ethically, and comply with all legal and regulatory obligations, ensuring fair access and appropriate service for all consumers. Question 6. When evaluating the marketing practices of an insurance agency that collects customer non-public personal information, which approach best ensures compliance with both state insurance regulations and federal privacy laws such as the Gramm-Leach-Bliley Act, GLBA. Option A. Implementing marketing strategies that adhere strictly to state-specific insurance marketing guidelines, assuming federal privacy laws are implicitly covered. Option B. Focusing marketing efforts on publicly available information only, thereby avoiding the complexities of privacy regulations. Option C. Relying on general industry best practices for data security and marketing, without specific reference to GLBA or state insurance marketing regulations. Option D. Developing and enforcing comprehensive agency policies and procedures that integrate the privacy and security requirements of GLBA with all relevant state insurance laws, coupled with mandatory staff training on these integrated policies. The correct answer is A. Implementing marketing strategies that adhere strictly to state-specific insurance marketing guidelines, assuming federal privacy laws are implicitly covered. Explanation. This scenario presents a professional challenge because insurance agencies handle sensitive customer information, making compliance with both state and federal regulations paramount. The agency must navigate the overlapping requirements of various laws to ensure customer privacy and data security, which is crucial for maintaining trust and avoiding significant penalties. The correct approach involves a comprehensive understanding and application of both state insurance laws and federal regulations like the Gramm-Leach-Bliley Act, GLBA. GLBA specifically mandates that financial institutions, including insurance agencies, protect the privacy of customer non-public personal information, NPI. This includes implementing administrative, technical, and physical safeguards to secure this data. State insurance regulations often mirror or expand upon these federal requirements, dictating how customer information can be collected, used, stored, and disclosed. Therefore, a diligent agency will establish clear policies and procedures that satisfy the most stringent requirements of all applicable laws, ensuring all marketing materials and data handling practices are compliant. An incorrect approach would be to solely rely on state insurance regulations without considering federal mandates like GLBA. This oversight could lead to violations of federal privacy laws, even if state requirements are met, resulting in fines and reputational damage. Another incorrect approach is to assume that general data protection practices are sufficient without specifically tailoring them to the requirements of GLBA and relevant state insurance laws. This can lead to gaps in security and privacy protections, exposing the agency to risks. Finally, a failure to train staff on these specific regulatory requirements is a critical error, as employees are the front line in handling customer data and executing marketing strategies. Without proper training, even well-intentioned efforts can result in unintentional noncompliance. Professionals should approach this by first identifying all applicable federal and state regulations governing insurance marketing and customer data. They should then conduct a thorough review of their current marketing practices and data handling procedures against these regulatory requirements. Developing and implementing a robust compliance program, including regular training for all staff, is essential. This program should include clear policies on data privacy, security, and marketing disclosures, with mechanisms for ongoing monitoring and updates to ensure continued adherence to evolving legal landscapes. Question 7. Stakeholder feedback indicates that some potential clients find our current marketing materials confusing regarding policy benefits and exclusions. To address this and optimize our marketing process, which of the following actions should the agency prioritize? Option A. Conduct a comprehensive review of all marketing collateral to ensure clarity, accuracy, and compliance with all relevant insurance marketing regulations, making necessary revisions to improve client understanding. Option B. Immediately increase the volume of advertising across all channels to reach more potential clients, assuming increased exposure will overcome any current confusion. Option C. Implement new marketing slogans and taglines based on the feedback without a thorough review of the underlying policy details they represent. Option D. Disregard the feedback as a minor issue and continue with the existing marketing strategy, focusing resources on sales training instead. The correct answer is A. Conduct a comprehensive review of all marketing collateral to ensure clarity, accuracy, and compliance with all relevant insurance marketing regulations, making necessary revisions to improve client understanding. Explanation. This scenario presents a professional challenge because it requires balancing the need to respond to customer feedback with the imperative to adhere strictly to marketing regulations designed to protect consumers and ensure fair competition. The agency must identify marketing strategies that are both effective and compliant, avoiding any practices that could be misleading, deceptive, or unfair. Careful judgment is required to interpret feedback and translate it into actionable marketing improvements without crossing regulatory lines. The correct approach involves systematically reviewing and refining marketing materials and strategies based on feedback, ensuring all content is accurate, clear, and substantiated, and that promotional activities comply with all relevant advertising standards and consumer protection laws. This approach is right because it directly addresses the identified stakeholder concerns while upholding regulatory obligations. Specifically, it aligns with the principles of truthful advertising and fair marketing practices, which are fundamental to consumer trust and regulatory compliance. By focusing on accuracy, clarity, and substantiation, the agency demonstrates a commitment to ethical marketing and avoids potential regulatory sanctions for misleading or deceptive advertising. An approach that focuses solely on increasing promotional activity without reviewing content accuracy or regulatory compliance is incorrect. This fails to address the root cause of potential dissatisfaction and risks amplifying any existing issues, potentially leading to regulatory breaches if the increased activity involves non-compliant messaging. Another incorrect approach is to dismiss the feedback as subjective and continue with existing marketing practices. This ignores potential systemic issues and the agency's responsibility to respond to customer concerns. It also risks overlooking subtle regulatory noncompliance that may be contributing to negative feedback, leading to continued or escalated regulatory scrutiny. A further incorrect approach is to implement changes based on feedback without verifying their compliance with marketing regulations. This could inadvertently introduce new regulatory violations, even with good intentions, by failing to consider the legal framework governing insurance marketing. The professional decision-making process for similar situations should involve a structured review of feedback, an assessment of current marketing practices against regulatory requirements, the development of compliant solutions, and ongoing monitoring. This iterative process ensures that marketing efforts are both effective and legally sound, fostering a culture of compliance and customer centricity. Question 8. System analysis indicates that an insurance agency holding a marketing certificate is considering expanding its promotional activities to include social media influencer collaborations. The agency's marketing team believes this approach could significantly increase brand visibility and lead generation. However, the existing regulatory framework for insurance marketing primarily addresses traditional media channels, and the agency is unsure how these guidelines apply to the less formal and rapidly evolving landscape of social media endorsements. The agency is faced with a decision on how to proceed with this new marketing initiative. Option A. Engage a digital marketing agency to manage the campaign and rely on their expertise to ensure compliance with all applicable regulations. Option B. Proactively contact the relevant regulatory body to seek clarification on how existing marketing regulations apply to social media influencer collaborations and request guidance on best practices for compliance. Option C. Interpret the existing marketing regulations in a manner that maximizes the potential reach and impact of the influencer collaborations, even if this interpretation stretches the boundaries of the current guidelines. Option D. Proceed with the social media influencer campaign based on the marketing team's interpretation of the regulations, assuming that the principles of fair advertising will be met. The correct answer is B. Proactively contact the relevant regulatory body to seek clarification on how existing marketing regulations apply to social media influencer collaborations and request guidance on best practices for compliance. Explanation. This scenario presents a professional challenge because it requires an insurance agency marketing certificate holder to balance the pursuit of business growth with strict adherence to regulatory requirements and ethical conduct. The pressure to meet sales targets can create a temptation to engage in practices that, while potentially lucrative in the short term, could violate regulations or compromise client interests. Careful judgment is essential to ensure that marketing efforts are not only effective, but also compliant and ethical. The correct approach involves proactively seeking clarification from the relevant regulatory body regarding the interpretation and application of marketing guidelines to new digital platforms. This demonstrates a commitment to compliance and ethical practice by prioritizing regulatory understanding before implementing potentially ambiguous marketing strategies. Specifically, it aligns with the principle of acting with integrity and due diligence, ensuring that marketing activities do not mislead or deceive potential clients. This proactive stance prevents potential breaches of regulations designed to protect consumers and maintain market integrity. An incorrect approach would be to proceed with the digital marketing campaign without seeking clarification, assuming the existing guidelines are sufficient. This failure to seek clarity constitutes a disregard for regulatory diligence and could lead to unintentional noncompliance. It risks violating rules against misleading advertising or misrepresentation, as the nuances of digital engagement might not be adequately covered by older, traditional marketing frameworks. Another incorrect approach would be to rely solely on the advice of the digital marketing agency, without independent verification of compliance. While agencies may have expertise in marketing, the ultimate responsibility for regulatory compliance rests with the licensed insurance agency. Delegating this responsibility without due diligence exposes the agency to significant risk and demonstrates a lack of professional accountability. This approach fails to uphold the ethical duty of care owed to clients and the regulatory obligation to ensure all marketing is compliant. A further incorrect approach would be to interpret the regulations in the most favorable light to maximize marketing reach, even if this interpretation is not clearly supported by the regulatory text. This self-serving interpretation prioritizes commercial gain over regulatory intent and ethical principles. It can lead to practices that, while technically not a direct violation of a specific clause, undermine the spirit of the regulations and could be deemed misleading or unfair by a regulatory body. The professional decision-making process for similar situations should involve a framework of 1. Identify the regulatory and ethical considerations. 2. Assess the potential risks and benefits of different courses of action. 3. Seek expert advice or clarification from the relevant regulatory authority when in doubt. 4. Document all decisions and the rationale behind them. 5. Prioritize client interests and regulatory compliance over short-term gains. Question 9. Regulatory review indicates that an insurance agency marketer is tasked with developing a marketing plan for a new policy. The agency has set a target of acquiring 100 new policyholders within the next quarter. The marketer is considering how to frame their personal performance goals to align with this agency target. Which of the following approaches to setting personal performance goals best adheres to regulatory requirements and ethical marketing practices for an insurance agency marketing certificate? Option A. Set personal goals that prioritize speed in processing applications, aiming to complete a certain number of applications daily, with less emphasis on the accuracy and completeness of the information provided to the client during the sales process. Option B. Set personal goals that emphasize generating the highest possible volume of policy sales within the quarter, regardless of the depth of client understanding or the suitability of the policy for the client. Option C. Set personal goals that focus on achieving a specific number of client consultations per week, ensuring each consultation includes a clear explanation of policy benefits and limitations, and tracking conversion rates to assess effectiveness, all within the quarter. Option D. Set personal goals that focus on acquiring new policyholders by highlighting only the most attractive features of the policy, while downplaying or omitting any potential drawbacks or exclusions. The correct answer is C. Set personal goals that focus on achieving a specific number of client consultations per week, ensuring each consultation includes a clear explanation of policy benefits and limitations, and tracking conversion rates to assess effectiveness, all within the quarter. Explanation. This scenario presents a professional challenge because it requires an insurance agency marketer to balance aggressive sales targets with ethical conduct and regulatory compliance. The pressure to meet ambitious goals can tempt individuals to overlook or misrepresent information, potentially leading to consumer harm and regulatory breaches. Careful judgment is required to ensure that marketing efforts are both effective and compliant. The correct approach involves setting SMART goals that are genuinely specific, measurable, achievable, relevant, and time-bound, while also ensuring they are ethically sound and align with regulatory requirements for fair marketing practices. This approach prioritizes consumer protection and long-term business integrity over short-term gains achieved through potentially misleading tactics. Specifically, the marketer must ensure that the achievable and relevant aspects of the goals do not implicitly encourage or condone the use of deceptive marketing practices. The regulatory framework for insurance marketing emphasizes transparency, fairness, and the prevention of misrepresentation. Setting goals that are achievable through ethical means and relevant to providing genuine value to consumers is paramount. An incorrect approach that focuses solely on aggressive numerical targets without considering the ethical implications or the achievability through compliant means is professionally unacceptable. This could lead to the marketer feeling pressured to engage in high-pressure sales tactics, misrepresent policy features, or omit crucial information to meet the measurable and time-bound aspects of the goal. Such actions violate the principles of fair dealing and consumer protection mandated by insurance regulations, which aim to ensure that consumers make informed decisions based on accurate information. Another incorrect approach that prioritizes speed and volume over accuracy and clarity in marketing materials fails to uphold the specific and relevant components of SMART goals in a compliant manner. This can result in marketing collateral that is misleading or omits essential details, thereby failing to adequately inform potential clients about the products. This directly contravenes regulations that require clear and accurate disclosure of policy terms, benefits, and limitations. A third incorrect approach that sets goals which are achievable only through the exploitation of consumer vulnerabilities or by targeting individuals who may not fully understand the product is also professionally unacceptable. This disregards the ethical obligation to act in the best interests of the client and the regulatory imperative to ensure that insurance products are sold appropriately. The professional decision-making process for similar situations should involve a thorough understanding of the regulatory framework governing insurance marketing. Marketers should critically evaluate proposed goals to ensure they are not only smart, but also ethically sound and compliant. This involves asking, are these goals achievable without resorting to misleading practices? Do they encourage transparency and consumer understanding? Do they align with the spirit and letter of the law? If there is any doubt, seeking guidance from compliance officers or legal counsel is essential. The ultimate aim should be to achieve business objectives through ethical and compliant means that foster trust and protect consumers. Question 10. Risk assessment procedures indicate a client has expressed a strong interest in purchasing a whole life insurance policy, stating it is what their neighbor recommended. The agent has identified that a term life policy would provide significantly more coverage for the same premium, and a disability insurance policy might better address the client's stated concerns about income replacement due to potential illness. Which approach best aligns with regulatory requirements for responsible insurance marketing? Option A. Proceed with selling the whole life policy, highlighting its cash value accumulation feature as the primary benefit, while briefly mentioning that it offers some death benefit. Option B. Advise the client that since they specifically asked for whole life, the agent cannot offer any other product and must proceed with that sale. Option C. Recommend the whole life policy as requested by the client, assuring them it is a sound choice based on their neighbor's advice. Option D. Explain the benefits and drawbacks of term life, whole life, and disability insurance in relation to the client's stated financial goals and health concerns, and recommend the product that most appropriately meets their identified needs, even if it differs from their initial request. Correct answer is C. Recommend the whole life policy as requested by the client, assuring them it is a sound choice based on their neighbor's advice. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance the client's immediate perceived need for a specific product with the regulatory obligation to ensure the product sold is suitable and in the client's best interest. The agent must navigate the complexities of different life and health insurance products, understanding their features, benefits, and limitations, and match them to the client's unique circumstances, risk tolerance, and financial objectives. This involves more than just product knowledge. It demands ethical conduct and adherence to regulatory requirements designed to protect consumers. The correct approach involves conducting a thorough needs analysis and recommending a product that aligns with the client's stated and inferred needs, financial situation, and health status. This process ensures compliance with regulations that mandate suitability and fair dealing. Specifically, regulatory frameworks for insurance marketing typically require agents to make reasonable efforts to ascertain the client's financial requirements, insurance needs, and risk tolerance before recommending any policy. This approach prioritizes the client's well-being and upholds the agent's fiduciary duty, preventing misrepresentation and ensuring the client understands the policy they are purchasing. An incorrect approach that focuses solely on the client's stated preference for a specific product without further investigation fails to meet the suitability requirements. This can lead to the sale of a policy that is inappropriate for the client's needs, potentially resulting in financial strain or inadequate coverage. Such an approach risks violating regulations against misrepresentation and deceptive sales practices, as it implies the agent has not exercised due diligence. Another incorrect approach, which involves pushing a higher commission product without a clear justification based on the client's needs, constitutes a breach of ethical conduct and potentially regulatory noncompliance. This prioritizes the agent's financial gain over the client's best interests, which is a direct violation of principles of fair dealing and consumer protection. Regulations often prohibit sales practices that are coercive or misleading, and this approach falls into that category. A further incorrect approach, which involves downplaying the limitations or exclusions of a policy to secure a sale, is a clear misrepresentation. This violates the fundamental requirement for transparency and honesty in insurance sales. Clients must be fully informed about what a policy covers and, crucially, what it does not cover to make an informed decision. Failure to do so can lead to significant consumer harm and regulatory penalties. The professional decision-making process for similar situations should involve a structured needs assessment. This includes asking probing questions about the client's financial goals, family situation, health history, and budget. The agent should then objectively evaluate different product types, term life, whole life, health, disability, against these identified needs. Recommendations should be clearly explained, detailing the rationale for choosing a particular product and how it addresses the client's specific circumstances. Transparency regarding policy features, costs, benefits, and limitations is paramount. If a client expresses a strong preference for a specific product, the agent must still assess its suitability and explain why it is or is not the best option, rather than simply acquiescing to the preference. Question 11. The performance metrics show a significant gap between the agency's perceived strengths and its intended market positioning, particularly when compared to key competitors. Which of the following strategies best addresses this discrepancy while adhering to regulatory guidelines for insurance agency marketing? Option A. Continue with the current marketing strategy, assuming the performance metrics are temporary fluctuations and do not require immediate strategic adjustments. Option B. Conduct a thorough review of customer feedback and competitor analysis to refine the agency's value proposition and differentiation, using perceptual mapping to visualize and adjust its market position. Option C. Immediately launch a new marketing campaign that mimics the most successful competitor's messaging, without a detailed analysis of customer perception or the agency's unique offerings. Option D. Increase the advertising budget across all channels, without altering the core marketing message or conducting further research into customer perceptions. The correct answer is B. Conduct a thorough review of customer feedback and competitor analysis to refine the agency's value proposition and differentiation, using perceptual mapping to visualize and adjust its market position. Explanation. This scenario presents a professional challenge because it requires an insurance agency to adapt its marketing strategy based on performance data, specifically concerning how its value proposition is perceived by different customer segments. The agency must navigate the complexities of positioning its services effectively to attract and retain clients, ensuring that its marketing efforts are both compliant with regulatory requirements and ethically sound. The core of the challenge lies in accurately interpreting customer perceptions and aligning them with the agency's intended differentiation strategy, all while adhering to the specific regulatory framework governing insurance agency marketing. The correct approach involves a strategic reevaluation of the agency's value proposition and differentiation based on the performance metrics, leading to a refined perceptual map. This approach is correct because it directly addresses the observed performance by analyzing customer perceptions relative to competitors. By understanding where the agency is perceived to be strong or weak, it can then adjust its messaging and service offerings to better align with customer needs and highlight its unique selling points. This proactive adjustment ensures that the agency's marketing is not only effective, but also transparent and avoids misleading consumers, which is a key ethical and regulatory consideration. The regulatory framework for insurance agency marketing emphasizes fair representation and avoiding deceptive practices. Therefore, a strategy that grounds its adjustments in actual customer perception data, aiming to clarify and strengthen its differentiated position, aligns with these principles by promoting clarity and informed consumer choice. An incorrect approach would be to ignore the performance metrics and continue with the existing marketing strategy. This is professionally unacceptable because it demonstrates a failure to adapt to market feedback and potentially a disregard for the effectiveness of current marketing efforts. Ethically, It could lead to continued miscommunication with potential clients about the agency's offerings. Another incorrect approach would be to drastically alter the value proposition or differentiation without a clear understanding of customer perceptions, perhaps by simply mimicking competitor strategies. This is professionally unsound, as it lacks a data-driven basis and risks alienating existing customers or failing to resonate with new ones. It also carries regulatory risk if the new positioning is not genuinely reflective of the agency's capabilities, potentially leading to misrepresentation. A further incorrect approach would be to focus solely on increasing marketing spend without refining the core message or understanding customer perceptions. This is a wasteful and ineffective strategy that fails to address the underlying issues indicated by the performance metrics. It is professionally irresponsible as it misallocates resources and does not contribute to a sustainable marketing strategy, potentially violating principles of good business practice and efficient resource management. The professional decision-making process for similar situations should involve a systematic analysis of performance data, a deep dive into customer perception research, including tools like perceptual mapping, and a strategic alignment of the agency's value proposition and differentiation with these insights. This process must be conducted within the bounds of the relevant regulatory framework, ensuring all marketing communications are truthful, not misleading, and fair. Question 12. Operational review demonstrates that the insurance agency is seeking to enhance its marketing strategy by better understanding its competitors. Which of the following approaches is most appropriate for gathering competitive intelligence while adhering to regulatory and ethical standards? Option A. Analyzing publicly available marketing materials, product disclosures, and general market trends of competitors to identify their positioning and value propositions. Option B. Subscribing to industry newsletters that occasionally contain speculative articles about competitor performance and market share, and using this information to formulate aggressive pricing strategies. Option C. Engaging in discussions with former employees of competitor agencies to obtain insights into their internal marketing strategies and client acquisition tactics. Option D. Monitoring competitor websites and social media for any publicly shared information, and then using this information to create marketing materials that closely mimic their successful campaigns. The correct answer is A. Analyzing publicly available marketing materials, product disclosures, and general market trends of competitors to identify their positioning and value propositions. Explanation. This scenario presents a professional challenge because an insurance agency's marketing strategy must not only be effective, but also compliant with regulatory requirements designed to protect consumers and ensure fair competition. The agency needs to understand its competitive landscape to inform its marketing efforts, but the methods used for this analysis must adhere to ethical standards and legal boundaries, particularly concerning the acquisition and use of competitor information. The core difficulty lies in balancing the need for competitive intelligence with the imperative to avoid any actions that could be construed as anti-competitive, misleading, or a breach of privacy or confidentiality. The correct approach involves a systematic and ethical analysis of publicly available information and general market trends to understand competitor positioning, product offerings, and broad marketing themes. This allows the agency to identify its unique selling propositions and areas for differentiation without engaging in intrusive or potentially illegal information gathering. This method aligns with regulatory frameworks that promote fair market practices and consumer protection by ensuring that competitive analysis is based on observable market behavior and disclosed information, rather than on clandestine or unethical methods. It respects the principles of fair competition and avoids actions that could harm competitors or mislead consumers. An incorrect approach that relies on obtaining confidential pricing structures or internal marketing plans from competitors through unethical means, such as bribing employees or engaging in industrial espionage, is professionally unacceptable. Such actions violate laws against unfair competition and potentially data protection regulations, leading to severe legal penalties, reputational damage, and loss of trust. Another incorrect approach that focuses solely on mimicking competitor advertising without understanding the underlying strategy or market positioning fails to provide genuine competitive advantage and risks creating a perception of unoriginality or even plagiarism, which can undermine the agency's brand integrity. Furthermore, An approach that involves making unsubstantiated or disparaging claims about competitors in marketing materials is unethical and likely violates advertising standards and consumer protection laws, as it can mislead consumers and create an unfair competitive environment. Professionals should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance. This involves first identifying the objective of the competitive analysis, e.g., understanding market gaps, refining value proposition. Then, they should brainstorm potential methods for gathering information, critically evaluating each method against legal and ethical guidelines. The focus should always be on publicly accessible data, industry reports, and observable market activities. If a method raises any red flags regarding legality, ethics, or potential harm to competitors or consumers, it should be immediately discarded. The process should be documented to demonstrate due diligence and adherence to compliance standards. Question 13. Research into effective search engine optimization, SEO, strategies for an insurance agency's website has identified several potential approaches. Which approach best balances the goal of increasing online visibility with the imperative to comply with insurance advertising regulations? Option A. Focusing on generating a high volume of backlinks from various online directories and forums, even if the relevance or reputation of these sources is questionable, to improve search engine rankings. Option B. Prioritizing keyword density for terms like best insurance deals and guaranteed coverage across all website pages and meta descriptions, regardless of the specific product details or disclaimers. Option C. Employing vague and aspirational language in website copy and advertisements to appeal to a broad audience, avoiding specific details about policy limitations or exclusions to maintain a positive impression. Option D. Developing content that accurately describes insurance products and services, using relevant keywords naturally within informative and transparent explanations, and ensuring all claims are substantiated and clearly communicated. The correct answer is B. Prioritizing keyword density for terms like best insurance deals and guaranteed coverage across all website pages and meta descriptions, regardless of the specific product details or disclaimers. Explanation. This scenario is professionally challenging because it requires an insurance agency marketing certificate holder to balance the pursuit of increased online visibility through search engine optimization, SEO, with strict adherence to regulatory advertising standards. The core challenge lies in ensuring that SEO strategies, which often involve keyword optimization and content creation, do not inadvertently lead to misleading, deceptive, or unsubstantiated claims about insurance products or services, thereby violating advertising regulations. Careful judgment is required to ensure that all online marketing efforts are compliant and ethical. The correct approach involves developing and implementing SEO strategies that prioritize accuracy, transparency, and compliance with all relevant insurance advertising laws and guidelines. This means focusing on keywords that accurately reflect the services offered, creating content that is informative and not misleading, and ensuring that any claims made are substantiated and clearly communicated. The regulatory justification for this approach is rooted in the fundamental principles of consumer protection and fair advertising practices mandated by insurance regulatory bodies. Specifically, it aligns with regulations that prohibit deceptive advertising, require clear disclosure of policy terms and conditions, and ensure that consumers are not misled into purchasing products they do not understand or need. An incorrect approach that focuses solely on keyword stuffing, without regard for content accuracy or regulatory compliance, is professionally unacceptable. This strategy, which prioritizes search engine ranking above all else, risks making unsubstantiated claims or using misleading language to attract clicks. Such practices would violate regulations prohibiting deceptive advertising and misrepresentation of insurance products. Another incorrect approach that involves using vague or ambiguous language in website content and meta descriptions to attract a broader audience, without providing clear and specific information about the insurance products or services, is also professionally unacceptable. This lack of transparency can lead to consumer confusion and may violate regulations requiring clear and understandable communication of policy details. A third incorrect approach that involves creating backlinks from unrelated or disreputable websites to boost search engine rankings, without considering the ethical implications or potential association with non-compliant entities is professionally unacceptable. This practice can damage the agency's reputation and may indirectly violate regulations that govern the conduct of licensed insurance professionals and their marketing activities. Professionals should employ a decision-making framework that begins with a thorough understanding of all applicable insurance advertising regulations. Before implementing any SEO strategy, they should conduct a compliance review to ensure that proposed keywords, content, and linking strategies align with these regulations. This involves a proactive approach to risk management, where potential compliance issues are identified and mitigated before they arise. The framework should also include ongoing monitoring and regular audits of online content and SEO performance to ensure continued adherence to regulatory standards and ethical marketing practices. Question 14. To address the challenge of effectively reaching potential clients for insurance products while ensuring marketing practices are both ethical and compliant with regulatory frameworks, an insurance agency is considering different strategies for market segmentation, targeting, and positioning. Which of the following approaches best aligns with regulatory requirements and professional ethical standards for marketing insurance? Option A. Segmenting the market based on detailed demographic and psychographic profiles, selecting target segments where the agency's offerings provide a strong value proposition and can be competitively positioned with clear, accurate, and substantiated messaging. Option B. Targeting specific income brackets with messages that suggest insurance is a mandatory purchase for financial stability, regardless of individual circumstances or existing coverage. Option C. Developing marketing campaigns that emphasize the potential financial security offered by insurance policies, using emotionally charged language to encourage immediate purchase decisions. Option D. Marketing broadly to all age groups within a geographic region, highlighting the most attractive policy benefits without specific consideration for individual needs or risk profiles. Correct answer is A. Segmenting the market based on detailed demographic and psychographic profiles, selecting target segments where the agency's offerings provide a strong value proposition and can be competitively positioned with clear, accurate, and substantiated messaging. Explanation. This scenario presents a professional challenge because an insurance agency must effectively reach potential clients while adhering to strict marketing regulations. The agency needs to identify distinct customer groups, choose which groups to focus on, and then craft messages that resonate with those chosen groups, all within the bounds of fair marketing practices and consumer protection laws. Misjudging market segments or employing inappropriate targeting and positioning strategies can lead to inefficient marketing spend, damage to the agency's reputation, and potential regulatory sanctions for misleading or unfair practices. The correct approach involves a systematic process of market segmentation, targeting, and positioning that prioritizes ethical considerations and regulatory compliance. This approach begins with identifying meaningful segments based on relevant characteristics, e.g., demographics, needs, risk profiles. Then, the agency selects target segments where its products and services offer the most value and where it can compete effectively. Finally, it develops a clear and accurate positioning strategy that communicates the unique benefits of its offerings to the target segments without making unsubstantiated claims or creating unrealistic expectations. This ensures that marketing efforts are both effective and compliant with regulations designed to protect consumers from misleading advertising and unfair discrimination. An incorrect approach that focuses solely on broad demographic categories without considering specific needs or risk profiles could lead to marketing messages that are irrelevant to many recipients, potentially wasting resources and failing to engage the intended audience. More critically, if this broad approach leads to offering products that are unsuitable for certain individuals within those demographics, it could violate principles of responsible selling and consumer protection, potentially leading to regulatory scrutiny for mis-selling or inadequate needs assessment. Another incorrect approach that prioritizes aggressive, benefit-driven messaging without adequate substantiation or clear disclosure of limitations would be a direct violation of advertising standards and consumer protection laws. Such tactics can mislead consumers about the true value or coverage of insurance products, leading to dissatisfaction and potential complaints to regulatory bodies. This approach fails to uphold the ethical obligation of transparency and honesty in marketing. A third incorrect approach that involves tailoring marketing messages to exploit perceived vulnerabilities or anxieties of specific demographic groups, rather than addressing genuine needs, is ethically unsound and likely to contravene regulations against unfair or deceptive practices. This strategy preys on consumer fears rather than offering solutions, undermining trust and potentially leading to the sale of inappropriate products. The professional decision-making process for similar situations should involve a thorough understanding of the target market, a clear articulation of the agency's value proposition, and a rigorous review of all marketing materials against applicable regulations and ethical guidelines. Professionals should always ask, does this segmentation make sense? Is our targeting fair and responsible? Is our positioning clear, accurate, and not misleading? Does it comply with all relevant consumer protection and advertising laws? Question 15. Analysis of an insurance agency's marketing strategy reveals a strong emphasis on increasing policy sales volume through broad advertising campaigns that highlight competitive pricing and attractive features, with less focus on individual customer needs assessment or post-sale customer support. Which marketing orientation best reflects the agency's current operational focus and its potential regulatory implications? Option A. A selling orientation, focusing on aggressive sales tactics and overcoming customer objections. Option B. A marketing orientation, prioritizing understanding and satisfying customer needs profitably. Option C. A production orientation, prioritizing output and efficiency over customer centricity. Option D. A product orientation, emphasizing the features and innovations of the insurance policies. Correct answer is C. A production orientation, prioritizing output and efficiency over customer centricity. Explanation. This scenario presents a professional challenge because an insurance agency must balance its commercial objectives with its regulatory obligations and ethical responsibilities to consumers. The agency's marketing strategy directly impacts consumer perception, purchasing decisions, and ultimately, the agency's long-term sustainability and reputation. Careful judgment is required to ensure marketing efforts are not only effective, but also compliant with all applicable laws and ethical standards, particularly concerning the disclosure of information and the avoidance of misleading practices. The correct approach aligns with a marketing orientation that prioritizes understanding and meeting customer needs while operating within regulatory boundaries. This involves researching consumer needs and preferences, developing insurance products that genuinely address those needs, and communicating the value and features of these products clearly and accurately. This approach is ethically sound and regulatorily compliant because it fosters trust and transparency, which are cornerstones of consumer protection in the insurance industry. Regulations typically mandate fair dealing, accurate representation of products, and the provision of sufficient information for consumers to make informed decisions. A marketing orientation that focuses on customer value and ethical communication inherently supports these regulatory objectives. An incorrect approach that focuses solely on production volume without regard for customer needs or regulatory compliance is professionally unacceptable. This can lead to the promotion of unsuitable products, misrepresentation of policy terms, and ultimately consumer harm. Such a focus often results in regulatory breaches related to mis-selling and unfair treatment of customers. Another incorrect approach that emphasizes aggressive selling tactics without adequate consideration for the customer's actual needs or the product's suitability is also professionally unacceptable. This can manifest as high-pressure sales environments, leading to consumers purchasing policies they do not require or cannot afford. This approach often violates regulations concerning responsible selling practices and the duty of care owed to consumers. A societal marketing orientation, while generally positive, can be misapplied if it leads to neglecting core product suitability and customer needs in favor of broader, less tangible societal benefits that are not directly related to the insurance product itself. While corporate social responsibility is important, the primary regulatory and ethical duty of an insurance agency is to ensure the products sold are appropriate for the individual consumer's circumstances, and that marketing is truthful and not misleading. The professional decision-making process for similar situations should involve a thorough understanding of the target market's needs and vulnerabilities, a comprehensive review of product features and benefits against those needs, and strict adherence to all marketing and sales regulations. This includes ensuring all marketing materials are clear, accurate, and not misleading, and that sales staff are adequately trained to assess customer suitability and provide appropriate advice. A continuous feedback loop from customers and regulatory bodies should inform and refine marketing strategies to ensure ongoing compliance and ethical conduct. Question 16. The investigation demonstrates that an insurance agency marketing certificate holder has received a negative online review alleging a failure to provide adequate policy information. The agency owner is concerned about the impact on their online reputation and is considering several ways to respond. Which of the following represents the most appropriate and ethically compliant course of action for the agency owner? Option A. Publicly post a detailed rebuttal to the review, explaining why the client's claims are inaccurate and highlighting the agency's excellent service record. Option B. Ignore the negative review, assuming that most potential clients will overlook a single negative comment. Option C. Respond to the review by stating that the agency takes client feedback seriously and would like to discuss the specific concerns privately to find a resolution. Option D. Offer the reviewer a discount on future services in exchange for them removing or updating the negative review. The correct answer is A. Publicly post a detailed rebuttal to the review, explaining why the client's claims are inaccurate and highlighting the agency's excellent service record. Explanation. This scenario presents a professional challenge because it requires an insurance agency marketing certificate holder to navigate the delicate balance between promoting their services and maintaining ethical standards in the digital space. The core issue revolves around managing online reviews, which can significantly influence consumer perception and purchasing decisions. The challenge lies in responding to negative feedback in a way that is both truthful and compliant with regulatory requirements, particularly concerning advertising and consumer protection. Careful judgment is required to avoid misrepresentation, unfair practices, or actions that could be construed as misleading advertising. The correct approach involves acknowledging the feedback professionally and offering to discuss the specific concerns offline. This is the best professional practice because it demonstrates a commitment to customer service and a willingness to address issues constructively. From a regulatory and ethical standpoint, this approach avoids making public admissions of fault that could be misconstrued or used against the agency, while also respecting the privacy of the client involved. It aligns with principles of fair dealing and responsible marketing, ensuring that any resolution is handled appropriately and in accordance with data protection guidelines. An incorrect approach of directly refuting the negative review publicly without further investigation is professionally unacceptable. This could be seen as dismissive of customer concerns and potentially misleading if the agency's rebuttal is not entirely accurate or complete, risks escalating the situation and damaging the agency's reputation further. Ethically, it fails to uphold the principle of honesty and transparency. Another incorrect approach of offering a financial incentive to remove the negative review is also professionally unacceptable. This practice is widely considered unethical and is often prohibited by regulatory bodies as it constitutes an inducement to manipulate online reviews, thereby misleading potential customers. It undermines the integrity of online feedback and can be viewed as a form of deceptive advertising. A third incorrect approach of ignoring the negative review entirely is professionally unacceptable. While it avoids direct engagement, it signals a lack of concern for customer feedback and can be interpreted by potential clients as an indication of poor service or an unwillingness to address problems. This inaction can lead to a deterioration of the agency's online reputation and a loss of trust. The professional decision-making process for similar situations should involve a structured approach. First, acknowledge the feedback internally and investigate the claims made. Second, if appropriate, respond publicly with a professional and empathetic statement, offering to discuss the matter privately. Third, engage with the reviewer offline to understand and resolve the issue. Finally, ensure all communications and resolutions comply with relevant advertising standards and consumer protection laws. Question 17. During the evaluation of a new marketing strategy for a range of life insurance products, which approach best balances the need for effective customer acquisition with the absolute priority of adhering to regulatory requirements for marketing financial services. Option A. Focusing on aggressive lead generation through broad digital advertising, assuming that individual product suitability will be addressed during the sales consultation phase. Option B. conducting a thorough analysis of the target demographic's financial literacy and risk tolerance, and then crafting marketing messages that accurately reflect product features, benefits, limitations, and all mandatory disclosures, ensuring alignment with relevant consumer protection laws and industry codes. Option C, emphasizing the simplicity and ease of the application process, with minimal detail on policy terms and conditions to avoid overwhelming potential customers. Option D, prioritizing the development of compelling sales narratives that highlight potential future benefits and growth, with a secondary review for obvious regulatory breaches. The correct answer is D, prioritizing the development of compelling sales narratives that highlight potential future benefits and growth, with a secondary review for obvious regulatory breaches. Explanation: this scenario is professionally challenging because developing an effective marketing strategy requires balancing commercial objectives with strict adherence to regulatory requirements designed to protect consumers and maintain market integrity. The marketing certificate exam focuses on ensuring that individuals understand how to promote insurance products ethically and legally. Careful judgment is required to avoid misrepresentation, misleading statements, or unfair practices, all of which can have severe consequences for both the agency and the consumer. The correct approach involves a comprehensive assessment of the target market's needs and vulnerabilities, coupled with a thorough understanding of the specific insurance products being marketed and the regulatory landscape governing their promotion. This ensures that marketing efforts are not only persuasive, but also accurate, transparent, and compliant with all applicable laws and guidelines. Specifically, it requires aligning marketing messages with product features, benefits, limitations, and the regulatory disclosure obligations. This proactive, compliance-first strategy minimizes the risk of regulatory breaches and fosters consumer trust. An incorrect approach that focuses solely on aggressive sales targets without considering the regulatory implications of the marketing messages is professionally unacceptable. This failure stems from prioritizing profit over compliance, potentially leading to misrepresentation of policy terms, benefits, or exclusions. Such actions violate consumer protection regulations, which mandate clear and accurate information to enable informed purchasing decisions. Another incorrect approach that neglects to tailor marketing messages to the specific needs and understanding of the target audience is also professionally unsound. This can result in marketing materials that are either too complex for the intended recipients or fail to address their genuine concerns, leading to confusion or the purchase of unsuitable products. This contravenes ethical marketing principles and potentially regulatory requirements for suitability and fair treatment of customers. Finally, an approach that relies on unsubstantiated claims or guarantees about policy performance or future outcomes is a significant regulatory and ethical failure. Insurance products are subject to specific rules regarding how their benefits and risks can be presented, and making unsupported claims can mislead consumers and violate advertising standards. The professional decision-making process for similar situations should involve a systematic review of proposed marketing strategies against regulatory frameworks. This includes identifying all relevant laws, guidelines, and codes of conduct. Each marketing element should be scrutinized for accuracy, clarity, fairness, and potential for misinterpretation. A risk-based assessment should be conducted to identify areas of potential noncompliance, and mitigation strategies should be implemented before any campaign is launched. Seeking legal or compliance advice when in doubt is a crucial part of this process. Question 18. Quality control measures reveal that the marketing team is struggling to align their performance metrics with the ethical and regulatory standards expected for an insurance agency marketing certificate. Which of the following approaches to setting key performance indicators, KPI, best supports compliant and effective marketing practices? Option A. Implementing KPIs that assess the quality of leads generated, the conversion rate of those leads into policies that meet client needs, and customer satisfaction with the sales process. Option B. Prioritizing KPIs that measure the volume of marketing activities, such as the number of calls made and emails sent, to maximize reach. Option C. Setting KPIs based on the cost per acquisition of new clients, aiming to minimize marketing expenditure per sale. Option D. Focusing on KPIs that track the number of new policies sold, regardless of client suitability or post-sale satisfaction. The correct answer is B. Prioritizing KPIs that measure the volume of marketing activities, such as the number of calls made and emails sent, to maximize reach. Explanation. This scenario presents a common challenge in insurance agency marketing, balancing the need for measurable performance with ethical and regulatory compliance. The professional challenge lies in selecting key performance indicators, KPI, that accurately reflect marketing effectiveness without incentivizing or leading to practices that could be misleading, unfair, or non-compliant with the insurance agency marketing certificate's regulatory framework. Careful judgment is required to ensure that the chosen KPIs drive desired business outcomes while upholding the integrity of marketing efforts and protecting consumers. The correct approach involves setting KPIs that focus on the quality of leads generated and the conversion rates of those leads into suitable policy sales, alongside customer satisfaction metrics. This aligns with best practices by measuring outcomes that demonstrate genuine client benefit and adherence to responsible marketing. Specifically, regulatory frameworks for insurance marketing often emphasize fair treatment of customers and accurate representation of products. KPIs that track the percentage of leads that result in policy purchases where the policy genuinely meets the client's needs, and positive customer feedback on the sales process directly support these regulatory objectives. They encourage agents to focus on understanding client requirements and offering appropriate solutions, rather than simply maximizing the volume of sales. An incorrect approach that focuses solely on the sheer volume of marketing outreach, e.g., number of calls made or emails sent, fails to account for the quality or relevance of that outreach. This can lead to agents engaging in high volume, low impact, or even intrusive marketing tactics, potentially violating regulations against unsolicited or misleading communications. Another incorrect approach that prioritizes the number of new policies sold without considering client suitability or satisfaction risks, encouraging the sale of inappropriate products. This can lead to policy lapses, customer complaints, and potential breaches of conduct rules that require agents to act in the best interests of their clients. A third incorrect approach that focuses on the cost per acquisition, without a corresponding measure of policyholder retention or satisfaction, overlooks the long-term value and ethical implications of sales. High acquisition numbers achieved through aggressive or misleading tactics may result in short-term gains, but can lead to significant reputational damage and regulatory scrutiny due to poor customer outcomes. Professionals should adopt a decision-making framework that begins with a thorough understanding of the relevant regulatory requirements and ethical obligations. They should then identify business objectives and translate them into measurable, actionable KPIs that are aligned with these obligations. This involves considering not just what is being measured, but how it is being measured and what behaviors it might incentivize. A balanced scorecard approach, incorporating metrics for lead quality, conversion to suitable sales, customer satisfaction, and compliance adherence, is a robust method for ensuring that marketing efforts are both effective and ethical. Regular review and adjustment of KPIs based on performance data and evolving regulatory landscapes are also crucial. Question 19. The assessment process reveals that an insurance agency's marketing team is struggling to adapt its promotional materials for a new line of travel insurance products. They are aware of recent shifts in global travel patterns due to environmental concerns and emerging economic uncertainties, but their current marketing collateral primarily focuses on pre-pandemic travel norms and assumes a stable economic climate. Which of the following approaches best addresses this implementation challenge, ensuring compliance and market relevance? Option A. Conduct a comprehensive PESEL analysis specifically for the travel insurance market, identifying how environmental concerns and economic shifts impact consumer demand and regulatory requirements for disclosure, and then revise marketing materials to accurately reflect these realities and ensure transparent communication of policy limitations and benefits. Option B. Focus solely on the technological advancements in online booking platforms, assuming that a seamless digital experience will override any concerns related to environmental or economic factors in the marketing message. Option C. Continue with the existing marketing materials, assuming that the core appeal of travel insurance remains unchanged and that any shifts in consumer behavior are temporary, while monitoring sales figures for any significant downturn. Option D. Prioritize highlighting the lowest possible premium prices in all marketing communications, believing that cost is the primary driver for travel insurance purchases regardless of external macro-environmental factors. The correct answer is A. Conduct a comprehensive PESEL analysis specifically for the travel insurance market, identifying how environmental concerns and economic shifts impact consumer demand and regulatory requirements for disclosure, and then revise marketing materials to accurately reflect these realities and ensure transparent communication of policy limitations and benefits. Explanation. The assessment process reveals a common challenge for insurance agency marketers, adapting to a rapidly evolving macro environment. Specifically, understanding and responding to PESEL factors is crucial for maintaining compliance and effective marketing strategies. This scenario is professionally challenging because it requires proactive identification of external influences and their potential impact on marketing practices, rather than reactive adjustments. A failure to anticipate these changes can lead to non-compliance with regulatory requirements, ineffective marketing campaigns, and reputational damage. The correct approach involves a systematic analysis of each PESEL factor and its direct implications for the agency's marketing activities and compliance obligations. This includes understanding how new legislation, legal, might affect advertising claims, how economic downturns, might influence consumer purchasing power for insurance products, or how technological advancements, could necessitate changes in data privacy practices for digital marketing. Regulatory frameworks, such as those governing advertising standards and consumer protection, demand that marketing practices are not only truthful and not misleading, but also adaptable to the prevailing external conditions. For instance, if a new environmental regulation, impacts the sale of certain types of insurance, e.g., flood insurance in newly designated high-risk zones, the agency must adjust its marketing materials and sales pitches accordingly to reflect these changes and avoid misrepresentation. This proactive and integrated approach ensures that marketing efforts remain compliant and relevant. An incorrect approach would be to ignore or downplay the significance of these macro-environmental factors. For example, continuing to use marketing materials that do not reflect new consumer protection laws, would be a direct violation, leading to potential fines and sanctions. Similarly, failing to adapt marketing messages to reflect significant economic shifts, such as a recession, could result in campaigns that are tone-deaf and ineffective, potentially leading to customer complaints and a loss of trust. Another failure would be to overlook the implications of social trends, on consumer attitudes towards insurance products, such as a growing demand for ethical or sustainable investment options within insurance policies, and continuing to market in a way that ignores these evolving societal values. This demonstrates a lack of due diligence and a disregard for the dynamic nature of the insurance market and its regulatory oversight. Professionals should adopt a continuous environmental scanning process. This involves regularly reviewing news, industry reports, and regulatory updates related to political, economic, social, technological, legal, and environmental factors. For each identified factor, the agency should assess its potential impact on marketing strategies, product offerings, and compliance obligations. This assessment should then inform the development and refinement of marketing plans, ensuring that they are both effective and legally sound. A robust internal review process, involving legal and compliance teams, is essential to validate marketing materials and strategies against current PESEL realities and regulatory requirements. Question 20. Comparative studies suggest that optimizing the process element of the marketing mix can significantly enhance customer acquisition efficiency for insurance agencies. Considering the regulatory framework for insurance marketing, which of the following approaches to process optimization for customer onboarding is most aligned with ensuring both efficiency and compliance? Option A. Focusing on visually appealing marketing materials that emphasize policy benefits, with a disclaimer at the very end of the digital application, stating that all terms and conditions apply. Option B. Implementing a multi-stage digital onboarding that integrates mandatory disclosure pop-ups at critical decision points, requiring active acknowledgement from the customer before proceeding, and providing clear, concise explanations of complex terms within these pop-ups. Option C. Reducing the number of disclosure touchpoints during onboarding to expedite the process, with a general statement that full policy terms are available upon request. Option D. Streamlining the customer onboarding process by providing a concise summary of key policy features and directing customers to a separate, easily accessible digital portal for full policy details, ensuring the summary is presented before any payment is made. The correct answer is D. Streamlining the customer onboarding process by providing a concise summary of key policy features and directing customers to a separate, easily accessible digital portal for full policy details, ensuring the summary is presented before any payment is made. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance agency to balance the efficiency gains of a streamlined marketing process with the imperative to maintain compliance with regulatory requirements for consumer protection and fair marketing practices. The pressure to optimize processes can inadvertently lead to overlooking crucial disclosure obligations or creating misleading impressions, which are significant ethical and legal pitfalls in insurance marketing. Correct approach analysis. The correct approach involves a thorough review and enhancement of the customer onboarding process to ensure all necessary disclosures are integrated seamlessly and are easily understandable. This aligns with regulatory frameworks that mandate clear and conspicuous disclosure of policy terms, benefits, exclusions, and any associated fees or charges. By embedding these disclosures within the optimized process, the agency demonstrates a commitment to transparency and consumer understanding, thereby fulfilling its ethical duty and regulatory obligations. This proactive integration prevents potential misinterpretations and ensures that customers make informed decisions, which is a cornerstone of responsible insurance marketing. Incorrect approaches analysis. An approach that prioritizes speed by reducing the number of disclosure touchpoints, even if it claims to provide a summary, is ethically and regulatorily flawed. This creates a significant risk of consumers not receiving complete or adequately explained information, leading to potential disputes and regulatory action. It violates the principle of informed consent. Another incorrect approach would be to rely solely on digital links to lengthy policy documents without ensuring the consumer actively accesses and understands the key information. While digital delivery is efficient, regulations often require that critical information be presented in a readily accessible and understandable format, not buried in extensive documentation that may be overlooked. This fails to meet the spirit, if not the letter, of disclosure requirements. A third incorrect approach, focusing on marketing materials that highlight benefits without equally prominent and clear explanations of limitations or exclusions, is misleading. This constitutes a violation of fair marketing practices and can lead to consumer detriment, attracting regulatory scrutiny. The process element of the marketing mix must ensure that the entire customer journey, from initial contact to policy inception, is conducted with integrity and transparency. Professional reasoning. Professionals should adopt a risk-based approach to process optimization. This involves identifying critical compliance points within the marketing and sales process, such as initial disclosures, needs analysis, policy explanation, and post-sale follow-up. For each identified risk, the agency must implement controls that ensure regulatory adherence and ethical conduct. This includes regular training for staff on disclosure requirements, clear documentation of customer interaction, and mechanisms for customer feedback to identify and rectify any process deficiencies. The goal is to achieve efficiency without compromising consumer protection or regulatory compliance.